Oh, wow. Of course, this is the first few awkward seconds of the live stream. So, what's going on today with this live stream that's not at my normal time? And I'm still planning to do a live stream later to talk about anything, but I wanted to talk about the FOMC meeting that's going on today. And really, I planned on doing a video on this, but I had to drop my kids off at school today because my wife is not feeling well, and which means I have to pick them up from school today too. So I'm not gonna have as much time as I normally do, but I wanted to get a video out on the what to expect from the FOMC and kind of what my opinion is. I shared an article earlier this week. This and a few other things have kind of formed the basis of my opinion on this, and of course, looking at past experience. So let's talk about the root of what's going on right now with the Fed, what to expect from the future, and how it's probably not as terrible as everyone thinks it is. And we can look at past historical examples to show that it's not. Okay, so the Fed is entering into a new era of policy, essentially, meaning that they're going to try to normalize the balance sheet, and they're going to try to normalize the interest rate environment. And they're going to try to do that all while creating this soft landing in the economy, right? So, all right, so let's address that soft landing part of the economy first. In the past, the Federal Reserve has overshot that mark numerous times, and we ended up, instead of having a soft landing, having a recession, right? But a lot of times they've gotten it correct as well, where they managed to tamp down on inflation. Yes, they slowed down the economy, but we didn't really enter into the textbook or the academic textbook definition of recession, which I think is retracting economy for 3 quarters in a row. Maybe 2 quarters, but I think it's actually 3. Anyway, so that is kind of what they're aiming for today, which is to cool the economy down, calm down inflation, that sort of thing. So I made an earlier video where I talked about the rate of inflation has the rate of increasing inflation has started to decelerate. So it's not that that inflation is declining; it's that acceleration has started to slow down, which means that we're not at the beginning of the end here of inflation at this point, but we are at the end of the beginning of inflation, which I think is pretty important to mention. Okay, so as we go into the meeting, and they're going to be coming out with, they're going to be publishing their remarks here in about 2 hours, and then at a half an hour later they're going to do a press conference with Jerome Powell. And so look, here's what I expect. I expect, number one, there's probably going to be a wrap up of quantitative easing in the form of the Fed buying securities on the open market. The first thing they're probably going to stop buying are the mortgage-backed securities, and they're going to stop buying government bonds as well, stop backstopping the bond market. Okay, that by itself is going to force a market-based rise in interest rates. Right? There's no way to avoid that. You're going to have, meaning that there's going to be less demand. I'm sorry. It's going to force a base raise in interest rates, just because you're not going to have that willing buyer out there at all times for $120 billion worth of assets. Hey, Bram, how's it going? Hey, Shoeless Joe, how's it going? Epic Hamster, Chris Thompson. Happy to see all of you guys. You guys are some of my regulars. So let's talk about continuing on with this. Right now, the Fed is buying $120 billion of assets every month. That has backstopped the market. They were looking to taper that off. What I expect is probably an announcement that they're going to taper that off a little bit early, which means it's only 6 weeks early that they're tapering this off. And that is going to do sort of the heavy lifting of their inflation policy at this point. That takes $120 billion out of the economy immediately every month going forward, right? So at the end of the year, that's almost $1 trillion. It's more than $1 trillion that would have been in the economy that's been sucked out, as well as we're looking at the end of some pandemic government spending as well going forward. So what I don't expect, and this is the big thing that I don't expect, is I don't expect an interest rate rise in this meeting. So what I do expect is the pretty firm announcement that our firm indication that we're going to have an interest rate rise going forward at the March 16th meeting. So we are absolutely looking to normalize our interest rate regime as well as to normalize the Fed's balance sheet. So what do I mean by normalize the Fed's balance sheet? Are they going to go out there and start selling what's on their balance sheet at this point? Well, they might. That's a distinct possibility. And I think that that would be a bit aggressive. And I think that Jerome Powell probably learned his lesson from being too hawkish in 2018. I don't know if you were around in 2018, because I know a lot of folks who listen to my channel are relatively new investors. But in 2018, when inflation was starting to heat up then, at least the economy was starting to heat up, and Jerome Powell wanted to put the brakes on the economy, he came out with some pretty hawkish statements on interest rates and had a really poor reaction. And the market declined pretty precipitously. And if you go back and look at the second year of the Trump administration, I think the market was only up like 4%. That's because it got crushed earlier in the year. I think he learned his lesson from that point. He's going to be a little bit more cautious in terms of turning on interest rates. But drying up the buying of securities already sucks out more than $1 trillion by the end of the year from Fed spending. So that's kind of under the radar. That's what people who are in the business realize is happening. That's what people who aren't in the business don't necessarily realize that's happening. But yeah, so that is one thing here. I think the big fear for a lot of people and what's affected the market is really been uncertainty. The market doesn't like uncertainty at all. The market likes clarity. And I think that the real fear was a 0.5 point or more interest rate rise, meaning that we are looking at, and that was, like I said, that was the big fear about what was going to happen at this meeting. I think that fear is completely overblown. I think that the markets, in fact, there's a whole betting market on how much the Fed is going to raise interest rates. And right now they've settled around 0.25 point and not until March 16th. I think it would be a big surprise, and it will have a negative effect on the market if they went ahead and raised rates at the end of this meeting. I do think that that's not likely to happen though. Okay. So it looks implausible at this point. So that ING article that I shared with you guys in the last month stated that the balance sheet was going to do the heavy lifting. So we're back to that. Balance sheet doing the heavy lifting. I think they're going to get rid of some of those mortgage-backed securities. It's time to do that. What I don't think they're going to do is go and sell those, those government-issued bonds, the treasuries. They're going to naturally let them mature, and they're simply not going to repurchase those assets. This would be a repeat of a strategy that was used between 2014 and 2020 that actually saw the Fed's balance sheet gradually and naturally shrink over time. As those assets matured, the principal was paid back to the Fed. And so anyway, so I'm getting questions here. I'm going to go back and answer some of the questions here in a little bit, guys. I just kind of wanted to talk about what's going on here. So that is what is going on with the Fed's balance sheet. That's what I predict is going to happen. There's not going to be any massive sales of government issued bonds. There will probably be some sales little by little of the mortgage-backed securities on their balance sheet. So other than as an emergency stopgap measure to stop sort of infection and panic in the rest of the market, I don't see a valid reason for the Federal Reserve to actually have collateralized debt obligations or mortgage-backed securities on their balance sheet. It doesn't seem right to me from an ethical standpoint. I think that the free market is the free market. Occasionally, you need to backstop something to prevent the entire free market from collapsing. But I think in terms of the housing market, that time is long past, and these securities should go out. So, so good news on the economic front. So consumer demand is down a bit, and this certainly plays into Jerome Powell's his concerns. Consumer demand for short-term and disposable items is actually down a little bit right now as people are afraid of inflation. But big purchases, and the survey that was done, I forget the name of the survey, but big services right now and big purchases are still in the cards. Most people who planned on a large purchase last year are still planning to buy a car. They're still planning to buy a home. Those plans haven't changed, and that's actually a very good sign for demand as well. So, so I'm here looking at my notes over here. One of the things that I expect that Powell's going to get a lot of questions on in the press conference is going to be liquidity issues. They're going to be asking a lot of questions about, is liquidity going to dry up overnight? Well, guys, liquidity is not going to dry up overnight. So if you're not old enough to remember a time prior to 2008 where people actually paid interest on money that they borrowed that was over and above inflation. Folks, that's the normal environment that we want to get back to. That is a healthy fixed income market. That's a healthy lending market. That's not one that's being backstopped by the government. So I want interest rates to rise in a manner that the market is able to digest. Generally, that's going to be 25 basis points per quarter. Okay. Any quicker than that, that's an indication that the government, or that that the Federal Reserve really wants to put the brakes on the economy, and that they're probably trying to engineer some, well, I don't want to say they're trying to engineer a recession, but they're trying to engineer a slowdown of the economy. So, yeah, anyway, I am open to questions now. I'm going to start talking a little bit more about kind of what went on with the market. Did get one question here. And I know I'm way behind, guys, because I talked for so long that I didn't answer the questions. But Tobu and CS says, are you surprised by the recent market sell-off? Do you see a further drop if they taper before March? I actually don't see. Okay, so number one, any predictions are basically worth they're not worth much, right? But here's my feeling on this, and I don't think it's worth any more or any less than anyone else's opinion. But if they announce an earlier taper before March, in my mind, it actually shouldn't matter that much, right? To the investor's mind, it might. But even if they announce that, it is not the fear of a taper that is causing the market to decline. It is not a fear of rising interest rates that is causing the market to decline. Everyone knows that interest rates are going to rise. Everyone knows that there's going to be a taper. It's the uncertainty surrounding it that has affected stock markets. So what I predict is going to happen is that after the Fed meeting, barring any giant change in policy, I mean, giant change in policy would be that they raise interest rates today, they do it more than 0.25%, or they end tapering and they raise interest rates all at the same time. So that would be a big departure from policy, right? What I predict is they may end tapering earlier than March. They probably won't, but they're going to give us a firm signal that interest rates are rising in March. What I predict is actually a relief rally from uncertainty, not because of anything real. People basically just don't like uncertainty. They've been positioning themselves. If you look at Monday and Tuesday, it looks like we saw a bit of a capitulation there, meaning that all of the selling that could be done was pretty much exhausted. Something like 40% of the stocks on the NASDAQ were down by 50% since the November 19th high. That is a lot of selling that is going on. And I personally, if I had more money, I'd be picking up more bargains. Granted, guys, I realize that my time horizon is really long compared to a lot of people. And, I've got basically no fear of rising interest rates because I don't need the money for a long time. So anyway, that's I'm not really surprised by the market sell-off. But let's talk about if the market is going to decline any further. Well, I did a little research on this, and from basically the 1940s to present, there have been something like 80 to 90 different times where the market has declined in magnitude just as much as it did on money, meaning went down like 1,000 points, right? So don't think of the 1,000 points. Think of the percentage that it went down. That's the magnitude that I'm talking about. So out of that 80 or 90 times that it went down by 1,000 points or so, at least, or that percentage in magnitude, how many times did it decline further by, say, another 20 to 30%? Well, the reality is it only did that 15% of the time. So if you have been in the market since November, you've been losing money, and then Monday rolls around and you sold out everything, right? Because that was your best guess. Well, 85% of the time, that best guess in the past has been incorrect. What's so different about today that's going to make it different today? So, basically, I don't think that there anything is this situation different? Yes, but every single situation is different than the one that preceded it. There is no exact repeat of what happened in the past. So, so when the Fed stops buying debt and mortgages, who is going to be supporting the ballooning budget or even pay the coupon payments on the $28 trillion Fed debt? So what makes you think that the coupon payments aren't being paid on debt that's owed to the Federal Reserve right now? So the Fed can stop buying debt, and that's going to have no it's going to make no difference whatsoever on whether or not the government is actually collecting enough money to pay the coupon payments on the bonds. So $28 trillion in federal debt, $9 trillion of that is actually owned by the Federal Reserve. Another $9 trillion of that is owned by regular citizens and investors like you and me. And the rest of it is owned by foreign investors. So we do have a debt problem. It is a debt problem right now while interest rates are extremely low that I'm not particularly concerned about. What I want to see is, of course, is greater revenue collection and less spending from the government. That is not likely to happen under any circumstances. So yeah, we're kind of caught in a pickle here when it comes to wider fiscal policy, but that's not necessarily monetary policy, which is what the Federal Reserve covers. So I don't really do politics on fiscal or don't really do podcasts on fiscal policy because that is a political discussion, and I don't like to get too political on my channel. In fact, I rarely get political at all. Happy to talk about monetary policy though, totally different thing. So, yeah. So Mito says, "Hey Jason, what's the market cap price you're looking for at Xpong to buy more in 2022?" So I am actually going to do another live stream later on today, and I'll talk about that stuff. I really wanted to focus on what's happening with the Federal Open Markets Commission today. So I'd be more worried about the portion held by foreign investors. I'm not tremendously worried by that, and that's part of the reason why we're a reserve currency. Is because we've never defaulted on our debts, right? And if you look at like what happened when we got downgraded, I think we got downgraded in 2016 or 2017 when one of those budget fights happened. We went from our AAA rating down one notch, and basically it didn't matter. Bond values went up the next day, and I think the debt folks were pretty disappointed by the world reaction to that, and it was a world reaction to that. But guys, it's not because the United States is so good. It's because everyone else is so bad about paying on their debts. That's kind of the real issue here is that most other countries have defaulted on their debts at one point or another. But yeah, so that's one of the things that I would be worried about too. But it's bonds they're buying in the open market, Bram. We can't prevent people from buying bonds in the open market. There are lots of regular Americans that own bonds in the open market as well. So Goldmine says, does that mean after the meeting that if I wanted to buy a car or house, I'd be getting a higher interest rate loan? So yes, even before interest rates are officially going to rise, probably at the March 16th meeting, you're probably going to see market creep up in interest rates. Now, there's only one interest rate that the Federal Reserve actually controls, and everything else floats on the market, right? So you're going to see a drop off in demand for long-term government bonds, which out in the 20 and 30-year range, because $100 billion or so is not going to be purchased every month. So you are going to see a rise in interest rates because of that. So yeah. Hiker Dave says, thanks for the video. Good timing to provide clear information. Let me see here. Absolutely right. That money has been plowed into the economy. 18 trillion in the last 12 years to drive 7 trillion of GDP. In other words, this economy wasted almost 2/3 of the money put into it. Yeah, well, it was a government effort. What do you expect? So let me see here. Okay. Any other questions from you guys? Okay, let me see here. Going forward, do you think that these changes will produce a more favorable operating environment for SOFI? So SoFi's operating environment right now is actually pretty good, and it's being hamstrung though by a couple of things. Number one, the moratorium on student loan repayments. Number two, it's just being hamstrung by fear at this point. But it's not just SoFi; it's really all financials. You're going to see a bit of a lag in performance for financials for say 2 or 3 quarters, and then after that, you start to see them take advantage of that spread between. You go to a bank right now and you put $100,000 in the bank, you might get 0.3% annualized interest on that deposit, maybe even less than like 0.15%, right? But they're turning around and loaning that out on a mortgage at like 4% or even like 3.75%. That's actually not a ton of money to allow those banks to make a profit over the years, and it's below inflation at this point. So they're collateralizing these debts and they're removing and putting them into investment packages, and they are removing them from their balance sheets, and justifiably so. You don't want interest rate risk on your balance sheet. You're selling mortgages right now for less than what we're, even if we had the same inflation we had in 2019, they're still not going to make money over the long term right now. They're making that money in the origination fee, and that's not what they really want to do. So one of the things that we're going to see is as interest rates rise, we'll probably see a slimmer and slimmer market for collateral for mortgage-backed securities, which I think is not a terrible thing. Okay, now the structure of mortgage-backed securities has changed quite a bit since 2008, meaning that the definition of what is high quality, what is a high quality tranche, and what is a low quality tranche, and the size of those tranches have changed. And I don't know if you've done any research on this or not, but they are inherently safer investments, or maybe not safer investments. People realize the risk they're taking with those investments now, which they didn't before. And they're no longer described simply as investment grade. They have a lot of them are described with the risk they actually hold. So that is what's changed, is perception of mortgage-backed securities. But I would like to see fewer of these in the market. A lot of folks, regular folks who invest in them, even people that bought like Ginnie Mae's and things like that, they really didn't understand what they were buying, and they really didn't understand that what they were getting back was a combination of principal and interest, and it was reducing their future purchasing power. Okay, so are there any stocks that seem attractive to you after the recent dip? So I'm going to be covering more on stocks in my next live stream, and I'm going to be doing that like at 4 p.m. I just wanted to get this out today before the Federal Open Markets Commission, and I didn't have time to make a real video and actually edit it. I'm not sure my videos are actually any better than my live streams are, to be honest with you. So I can actually use some help and advice in that department. But yes, so I am enormously positive right now about this FOMC meeting. I'm actually thinking that what's happening today is already sort of a pre-relief rally. And even if I don't think that anyone reasonable is thinking that they're going to delay raising interest rates beyond March 16th. That is going to come up. They will raise interest rates at least by March 16th. And I don't think anyone reasonable is thinking that they won't. But folks, this is really not a terrible thing. My first home purchase that I made, I paid 9.75% interest. Part of that was because I had no credit, but the other part was just the time period that I did it in. That was a normalized market. It was perfectly normal to, you put your money in the bank in a savings account to get 2% interest on that, and you're paying 6% on a mortgage. Okay, so that is, that was entirely reasonable back in the day in terms of the exchange you get for a risk-free investment, which is a savings account or a CD, versus the risk that the bank is taking, loaning money out for 30 years, backed by an asset that could decline in value, which housing can decline in value depending on the neighborhood or time period that you purchase it in. But there's other things too, like business loans have been ridiculously cheap over the last couple of years. Like I have an SBA loan for 3.75%. If 80% of businesses fail in the first 5 years, me having an SBA loan on a 10-year basis at 3.75% seems a bit ridiculous. There would be very little chance that the SBA is going to make more money than inflation on that. So this is more of a lending, interest rates, banking type live stream today. You guys do know that I worked for banks for a number of years. I worked for military service providers that did lending and I worked for institutions that worked with government lending as well over the years. So I'm really familiar with some of the operations of how lending works, and especially the data on the back end. We have to get back to this environment because the Federal Reserve at this point, if we go through another real crisis, they invented new ways to deal with this because just interest rates that they controlled after, say, the crisis of 2000, 2001, 2002, just controlling interest rates wasn't enough to deal with crisis. And they created all these new tools. They would like to get back to a point where they don't have to create additional new tools for the next crisis that we have. And I think it's very important to start preparing for that today, even if it hurts a little bit, meaning even if some small businesses can't go out and get the credit that they need, even if a rise in interest rates prices some people out of a home, the market is ridiculously hot right now. I think that returning to a point where we're where we're not in a zero interest rate environment. We've been that way for 12 years now, right? For 13 years since that time period, where that is a weapon that the Federal Reserve has not been able to use for the last 12 years. And they don't want to be there. So don't look at this as all negative. It certainly isn't. It's preparing us for the next crisis. Interest rates, if you go back and look at history also, and you compare time periods when interest rates were rising and when interest rates were declining, you'll see that the market grew, the stock market grew many times, even when interest rates were rising. The market grew when interest rates were dropping. The market is not, don't fight the Fed. If the Fed comes out, let's say at the end of the year and says, hey, we're raising interest rates by a full point. Well, that's a different story. Don't fight the Fed. And that's a really old investing adage. The Fed is saying we want to slam on the brakes on the economy because something is out of control in the economy, and that's going to cause an immediate reaction. Yeah. How do you feel about Unity? Is it too rich? So I'll cover all that in the live stream that I'm going to do later on today at 4 p.m. 4 p.m. So yeah, very happy to answer questions, guys. Right now, mostly about Federal Reserve operations, banking, lending. What's this going to do to the general economy? I'll talk about stock markets in general right now. But yeah, so back to stock markets. What happened Monday and Tuesday to me looked like capitulation, where most people who could sell had sold at that point, and there were a lot of bargain hunters that came back in. If this is anything like any of the historical dips like this, 85% of the time, the market didn't really decline much further than it did on Monday, and we are looking at a recovery at some point. So look, from market correction to parity historically, that period is only 116 days, right? So I'm going to mention another YouTuber. Like I almost never mention other YouTubers, but somebody in my Patreon group. By the way, we had all this discussion in my Patreon group in a private Zoom meeting on Monday, but we didn't discuss this. I'm going to discuss Meet Kevin selling out his entire portfolio. So I happen to agree with Tom Nash. I don't believe that he sold it out because he has paper hands. I don't believe he sold it out because he had a choice. I think he got margin called, meaning I think that he had so much borrowed money, or he had bought so much stock with borrowed money that his brokerage basically said, all right, man, you got to pay up. Your accounts dropped too much. That's called a margin call, and they force you to sell. I think that's probably what happened to him. It is not reasonable, especially when he did this, it is not reasonable to expect that that between now and March 16th, when he says he wants to buy back in, it's not reasonable to expect that he's going to be able to make more than, say, roughly 18.8% on his stocks in that time period. It's not reasonable to expect that, right? And why do I use the number 18.8%? And it's actually going to be higher than that. Minimum would have to be 18.8%, but it's going to be higher than that, and here's why. Capital gains tax. A lot of what he probably, because of how young he is, a lot of what he probably has is in a taxable brokerage account. Now, some of that, of course, is going to be long-term capital gains, which is taxed fixed 15%. But between all the new taxes that were imposed by the change of tax regulations in 2018, he actually owes another 3.8% on top of that due to Medicare and I think to Medicare. So he owes another 3 points. So minimum he's going to pay on long-term capital gains on stocks that he's owned for a year or more is going to be 18.8%. Everything else is going to be taxed. And why? It's because of his tax bracket. I'm sure he makes more than $450,000 a year. I'm sure he's taxed at the top tax bracket. Everything else is going to be taxed at 37% plus the 3.8%. So plus whatever his state tax bracket is, he may have relocated to Las Vegas where there's no state tax, but still he's paying a minimum of 40.8% on anything short-term, 18.8% on anything long-term. You're not going to make that up between now and March 16th, right? So he has to bet that stocks are going to go down more than 18.8% in those couple of days, when 85% of the time in the past, that has not happened. So I don't believe that he caved and had paper hands, because I will not sell out of my smaller portfolio on this, because I don't want to take 1/5 of everything that I've made in the market in the last 10, 15 years and turn it over to the government. I don't want to do that. I want to pay taxes as little as possible on my terms. I have some leverage in my account. I generally don't have more than 25% of my account levered. I had a little bit more beginning of November and started to delever back in December, right? So I understand he probably got caught out, man. That happens to people. I've been margin called twice in my lifetime. Dude, it sucks, man. It's terrible. You're forced to sell out when you know prices are going to come back. So look, price parity from a decline like we had on Monday and Tuesday generally happens with a downturn like that from a pullback of 10 or 15%. In most cases, that return to parity happens in 116 days. I am not willing to bet 20% of my earnings on being down for only 116 days. I don't think you're going to make that up by selling out and buying back in. Now I've talked to a bunch of people that sold out completely. They're in completely different financial situations. They maybe have 10, 20, $100,000 invested. If you have a lot more than that, you have to really consider taxes, right? I'm not willing to do that, even in the extreme case that we go through a recession, where typically you see a return to parity from the high point pre-recession. You go through the low point, you're back to your high point typically in 19 months. I am not willing to pay the hundreds of thousands of dollars I would have to pay in taxes just to avoid seeing red for the next 19 months. This is one of the reasons why the more you have invested, the more of a long-term investor you become, because you're moving around larger amounts of money and your tax consequences become really consequential. They're not quite as consequential at certain income levels, but at his income level, it's extremely consequential. And that's why I don't believe that he chose to sell that. I don't believe that Kevin chose to sell out of his portfolio. I'm pretty sure that he got margin called. So that is my thing. So Anthony Walker says indexes are going up. So I'm not on any of my programs that show me that right now, but I'm not going to be surprised if they go up. I'm not going to be surprised that pretty much anything other than a hard left turn on interest rates, meaning they're going to raise them today and they're going to do like a half a point or more. I think anything other than that, you're probably going to see a market rally. And it's a relief rally. That's all it is. Anthony Walker says, pay attention. I don't have anything up right now, man. I'm totally focused on you guys. What is your opinion, speculation, guess about U.S. economy in the next 18 months? So, Michael, my opinion, speculation, and it is guess just about the U.S. economy in the next 12 to 18 months is this. It's actually going to be far better than we think. Right now, when you're looking at corporate profits, other than with a few exceptions like Netscape, where they outline, not Netscape, that really shows my old, Netflix, that really shows how old I am when I said Netscape. Anyone remember the Netscape browser? That's how old I am. I was a big fan of the Netscape browser. So look, Netflix really kind of set this off. There were a couple of reasons why that house of cards was going to topple a little bit. But Netflix really set it off. But they had very good reasons to describe why their viewership is not going to grow. It's simply a matter of timing. They don't have new shows coming out anytime in the near future. Their stock dropped like a rock 20%. I kind of understand that too. They're facing a lot of competition. In streaming. You can't, they don't have anything unique in streaming other than their content production, and they don't have any content production, a lot of new stuff really coming out until the latter half of 2022. So I kind of understand that. But other companies, corporate earnings right now have actually looked fairly good. The only issues they're having right now is higher costs due to inflation. And we're already seeing a deceleration of inflation, which, like I said earlier in the live stream here, is not necessarily the beginning of the end, but it's certainly the end of the beginning. Inflation acceleration has slowed down and it's done significantly over the last 3 weeks. So I don't think it's going to get tremendously worse before it starts to get better. I think over the next 12 to 18 months, we're probably going to eke out a gain in the market overall. I think that some of our most favored stocks right now in tech probably don't deserve to recover. The microvisions, Nano Dimensions, there's a number of different stocks I could talk about where they're not supported by fundamentals. Like, so right now, a lot of stocks are going down in spite of their fundamentals, and some stocks are going down along with the rest of the market, but they're not going to come back because of their fundamentals. All right. So corporate profits actually look pretty good right now. Not spectacular, but pretty good. And honestly, pretty good is fine for right now. I'm happy about that. So, and looks like when I mentioned Tommy Flanagan, there was an elbow cough and there was a fellow old person. Yeah. So you guys remember Netscape as well. So, all right. But yeah, anyway, that is all I have time for today. Like I said, I have limited time. I have some actual work to do. I'm going to be back at 4:00 to talk more generally about our favorite stocks, our favorite tech stocks. I have been making some purchases. Most of those were made last week. And I always say, you guys, I don't tell you guys either, 3 or 4 days before or 3 or 4 days after I make a purchase. Because I don't want to ever be accused of trying to pump the price or anything like that. So I'm already into some of these stocks. And some I don't have as much money this time going around with this downturn, so I haven't been able to invest as much. So I will be back at 4:00, and I look forward to hearing from you guys. Thank you very much for attending this. By the way, the super chat features were on the whole time. Nobody decided to indulge. That's cool, man. I'll see you guys at 4:00. All right, later.